Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our class on technical analysis. Tonight, we'll be trying to get a handle or understanding of what technical analysis is, because there's a huge misconception out there, and most people mix up technical indicators with the field of technical analysis. Now, before we get started, I need to read you a risk warning because ETX is a regulated provider. So let me read that and get it out of the way. Trading in the financial markets may result in the loss of your deposited funds. Please ensure that you fully understand the risks or seek independent advice if necessary. ETX Capital provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which is provided during this webinar is for educational purposes only and is not intended to be construed as a personal recommendation or advice. All traders must understand that there's a high element of randomness to the markets. Therefore, they will experience both winning and losing trades while following a trading strategy. Different traders following the same strategy will achieve different levels of performance. Past performance is not an indicator of future results. Now, for those of you that are joining us through an internet promotion and don't know much about us, ETX is a fast-growing financial services company based in London, and we are physically there. We are authorized and regulated by the FCA, the Financial Conduct Authority, and our parent company, Monocore London, is a member firm of the London Stock Exchange. Now, when you trade with ETX, you have a choice of either using our online web-based trader, our ETX Trader Pro, or you can download our ETX MT4 platform for a more professional environment. You can use both of them, either of them, whichever you would like. Our customer support department will make sure you get everything you need to trade the way you want. Now, we've just recently launched an all-new online version of our Trader Pro platform, and you can try it out by just opening a demo account, or if you're trading with the old platform, just go up to the top of your platform and you'll be able to click on to experience the new platform. And if you don't like it or you prefer the old way, just go back to exit the new platform, and it'll take you back to your old setup. So of course, we always want to make sure you get what you need to trade successfully while you're with ETX. Now, tonight's class is being recorded, and you can access a recorded version of this class in about 24 hours by going to using the same link you used to come to tonight's class. But give us some time to get it edited and uploaded, and it will be available to you. So let's get started talking about technical analysis. Now, tonight in the class, I'm going to use the term security a lot, or asset a great deal. So when I'm referring to a security or asset, I'm talking about any tradable financial instrument. This includes stocks, bonds, commodities, futures, indices, mutual funds, options, as well as CFDs or Forex. While I may imply a specific investment product, for example, I may say shares, which implies an equity, these investment concepts will work with any publicly traded financial instrument in which an open market exists. Similarly, I intermix the term investing and trading. Typically, an investor takes a long-term position, while a trader takes a much shorter-term position. With ETX, we should classify everybody as a trader. But sometimes I'll jump from investor to trader, but I'm referring to the same group of people, you and me. So in either case, the basic concepts and techniques presented tonight are pretty well the same. Now, the big question one might ask is, should I buy today? What will prices be tomorrow, next week, or next year? Or what will prices be in an hour from now? Wouldn't investing be easy if we knew the answer to these simple questions? Alas, if you are attending this class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you early. It doesn't. Technical analysis is not a crystal ball. However, if you're attending this webinar with the hope that technical analysis will improve your trading and investing, then I have good news for you. It will. Now, the term technical analysis is a complicated sounding name for a very basic approach to investing. Simply put, technical analysis is the study of prices with charts being the primary tool. A lot of us just call it charting or chart analysis or chartist. Some people want to refer to it as the high-end scientific evaluation of the markets. But the roots of modern-day technical analysis stem from the Dow theory, developed around 1900 by Charles Dow. Now remember, in those days, basically the only trading out there was the stock market or stocks. Stemming either directly or indirectly from Dow theory, these roots include such principles as the trending nature of prices. Prices discount all known information, confirmation and divergence in volume, mirroring changes in price and support and resistance. And of course, the widely followed Dow Jones Industrial Average is a direct offspring of the Dow theory. So basically, we say, look at that. Everything we could want to know about an asset, whether it's a CFD, whether it's a stock, whether we're trading it in a Forex, no matter how we're trading it, basically was all thought of by Charles Dow a long time ago, way before we had online trading, before we had CXD and Forex, before we had spread bets in the UK. Okay. Now, Charles Dow's contribution to modern-day technical analysis cannot be understated. His focus on the basics of a security price movement give rise to a completely new method of analyzing the markets. Now, we have to take in account one important thing, because a lot of people will say to me, well, isn't technical analysis like auto trading or algo trading or robotic trading or quant trading? Well, the thing is, robots and quants and AIs can't outsmart the human element. And because the price of an asset is the overall important factor, it is actually moved by human involvement. So the price of security represents a consensus. What's the consensus? What are buyers willing to buy and what are sellers willing to sell it for? How many buyers are there and how many sellers are? What is the demand? It is the price at which one person agrees to buy and another person agrees to sell. The price at which an investor is willing to buy or sell depends primarily on his expectations. If he expects the security to rise, he'll buy it. If he expects the security to fall, he will sell it. Now, these are simple statements on the cause of major challenge in focusing on security prices because they refer to the human expectation. As we all know firsthand, humans are not easily quantifiable nor predictable. This fact alone keeps any mechanical trading system from working consistently. It is your touch of your hand, you being involved in the markets, and it's your personal insight and your personal part of trading that makes you successful. Okay. Otherwise, we could just put every formula into a machine, let a machine trade all day and night long. You know, the hedge funds employ huge black boxes with all kinds of mathematical calculations, but ultimately it's the human being doing the buying and the selling. Now, because humans are involved, I am sure that much of the world's investment decisions are based on irrelevant criteria. Our relationship with our family, our neighbors, our employer, the traffic, our income, and our previous success and failures all influence our confidence, expectations, and decisions. Now, security prices are determined by money managers as well as home managers, students and strikers, doctors and dog catchers, lawyers and landscapers, and the wealthy and the wanting. Now, if we go back 20 years ago, even maybe 10 years ago, maybe not so 10, before the development of online trading, when we were all dealing with brokers on the phone and having to talk to a stockbroker to get their advice, to understand what's going on in the markets, to buy or to sell something. Okay, we might have been able to take a lot of today's action out of it because the people involved in the markets were a lot more professional. But today, we have as much money just about coming in from hedge funds and money managers as we do from online traders. So this has changed the market participants. And this has changed the element of unpredictability and excitement. It has shifted the entire markets. Now, one of the most important things in technical analysis is summed up in this one little statement. The future can be found in the past. If prices are based on investors' expectations, then knowing what a security should sell for becomes less important than knowing what other investors expected to sell for. Now, that's not to say that knowing what a security should sell for isn't important, but there is usually a fairly strong consensus of a stock's future earnings that the average investor cannot disprove. Now, in my experience, only a minority of technicians can consistently and accurately determine future prices. However, even if you are unable to accurately forecast prices, technical analysis can be used to consistently reduce your risk and increase your profits. Because no matter how you're going to trade, no matter how you're going to make a decision, whether you're going to buy Apple or you're going to sell Amazon because Donald Trump is all over Jeff Bezos, that might make your trading decision. But without technical analysis, you won't be able to determine what price to enter the markets. You won't be able to determine how far the market should fall. You won't be able to determine, is the market doing what I thought? Because all of this happens on a chart. And charts are the backbone of technical analysis. Now, the best analogy I can find out on how technical analysis can improve your investing is a roulette wheel. And I hate to mix up gambling and investing. Because if you're a gambler and you want to gamble, you shouldn't be in investing. You shouldn't be in trading. Because traders look to take all of the gambling, or as much as the gambling and guessing, out of the decision-making process. So I use this analogy with reservation, as gamblers have a very little control when compared to investors. Although considering the actions of many investors, gambling may be a very appropriate analogy. Now, a casino makes money on a roulette wheel not by knowing what number will come up next, but by slightly improving their odds with the addition of 0 and 00. Similarly, when an investor purchases a security, he doesn't know if that price will rise. But if he buys a stock when it is in a rising trend, maybe after a minor sell-off, and when interest rates are falling, he will have improved his odds of making a profit. That's not gambling, it's intelligence. It's strategy. It's using your brain. Yet many investors buy securities without attempting to control the odds. And trading is all about reducing your risk and only taking high probability profitable trades that fit your win-loss ratio or your profit-loss ratio, because it's all about minimizing your risk. So contrary to popular belief, you do not need to know what a security's price will be in the future to make money. Your goal should simply be to improve the odds of making profitable trades. Even if your analysis is simple, as determining the long, intermediate, and short-term trends of a security, you will have gained an edge that you would not have without technical analysis. Now, as mentioned earlier, a lot of us talk about automated trading and saying if you can just have to figure out trends and support and resistance and some algorithmic mathematical formulas, why can't you just use automated trading? So if we accept the fact that human emotion and expectations play a role in security pricing, We should also admit that our emotions play a role in our decision making. Many investors try to remove their emotion from their investing by using computers to make decisions. The concept of how, remember from 2001 Space Odyssey, in intelligent computing in the movie is appealing. But mechanical trading systems can help us remove our emotion from our decisions. They can help us in our decision-making capabilities, but they can't trade successfully. Computer testing is also useful to determine what has happened historically under various conditions. That is not to say that computers aren't wonderful technical analysis tools. They're indispensable. In my totally biased opinion, technical analysis software has done more to level the playing field for the average investor than any other non-regulatory event. Because all of this software, all these technical indicators, all of this charting, these scanners have all leveled us and given us the ability to react and act as well as the hedge funds and the big investment banks do. Because we now get the data, we can evaluate it quickly, we can use our computers. But as a provider of technical analysis tools, I caution you not to let the software lull you into believing markets are as logical and predictable as the computer you use to analyze them. Okay, so all of that said, let's talk about technical analysis, even if that's what we've been talking about. Technical analysis is based almost entirely on the analysis of price and volume. The field which defines a security's price and volume are pretty well explained. Okay. Technical analysis involves looking at patterns in price history to determine the higher probability time and place to enter and exit a trade. As a result, technical analysis is one of the most widely used types of analysis. Now, you all thought I was going to jump you over here and jump over, and we're going to talk about RSI and MACD and stochastics as the best trading tools out there. But they're a small field of technical analysis that's called indicators. Price movement and price is the ultimate decision making. Okay, seeing or analyzing that price on a chart, seeing past patterns and how the markets reacted in when these patterns developed, like when we saw a triangle or asymmetrical or a descending triangle before, or a head and shoulders pattern, and knowing how or predicting how the markets have reacted before can help us determine how the markets will react. Now, since online trading in most cases involves only major assets, the movement on a chart from the price action generally gives clues about hidden levels of supply and demand. Now, technical analysis is a bit of a misnomer since it is really not that technical. A better name for the use of charts to make investment decisions might be risk-reward analysis or even market psychology or just simply chartists, because everything and anything involving technical analysis occurs on a chart. Sure, there are some more complex mathematical concepts involved in some of the more esoteric indicators. But at its core, technical analysis is simply a method of determining if an asset is worth buying or selling. Once we identify this, we are way ahead of the game with regards to assembling a winning portfolio. So simply stated, technical analysis is the study of data generated from the market and from the actions of people in the market. Such data includes price levels that have served as turning points in the past, which we know as pivot points or support and resistance lines, the amount of stock being bought and sold, which is volume, which is put on our charts, and the rate of change of price momentum over a specific time period. And these are from momentum indicators. So technical analysis also attempts to measure the collective investor psyche, calling heavily on the psychology of crowds and the cycle of greed and fear. If everyone thinks one way, the odds that the market thinks the other is usually high. Was investor sentiment ever as negative as it was in March 2009 when the market put in a very important bottom when the market crashed? Critics will point out that forecasting future prices movement based on past price movement is akin to reading tea leaves or divining the future from textures of chicken entrails. Now it sounds like I'm a little bit negative, okay? But I'm a firm believer and a firm user of technical analysis, okay? Because I'm a firm believer that everybody should be able to look at a chart and understand what price actions tell you, see repeated patterns in those charts, see support and resistance levels, and see trend lines. Okay. Now, many of the high priests of fundamental analysis are quick to call technical analysis the financial world's alchemy. Indeed, chart watchers cannot predict the future any better than your broker, your spouse, or a Ouija board. Okay, that being said, we need to find entry points and exit points, and we need to know how to reduce our exposure and limit our risk and when to exit the market or the markets aren't reacting as we expected. And that is only found on price on charts. So, but what they can do better than most is make a decision about what to do, buy, sell, or hold, based on the probabilities of the actions of other given conditions. In other words, if a pattern on a chart appears, a chart watcher can create a framework for what the market might do if and when price breaks free. And this is why it's important. If you're watching charts and looking for patterns in charts, you may not know whether the assets can go up or down, but you're looking, you know, at this particular level, you need to get some type of an action. Whether it's going to bounce off support, bounce off resistance, break through support, break out of a triangle, break out of a wedge. Okay. Now, it does not work every time, but past performance does give us an idea of what will happen so we can do something about it. So, technical analysis relies on price action. It's based on everything that is happening on a chart. It includes the open and the high, the low and the close, sometimes referred to as OHLC, open, high, low, and close. Now, these are easily displayed in the form of a candlestick or a bar chart. We also can see volume. This is the number of shares or contracts that are traded during a period. And volume is dropped on our chart. Now, there are different volume indicators or straight volume, but this is going to be dropped on our chart right below price action. So let's go look at a chart and let's see this in real life. So hold on, let me pop up some charts here. Okay, now we're looking at the Euro US dollar 1 hour chart, and this is a current chart up to date. Let's get rid of stochastics down below. Okay, and what we're looking at is a Japanese candlestick price chart. Now, candlesticks are one of the ways that we can see price on a chart. Now, each one of those candlesticks is made up of an open, the high, the low, and the close for the particular time period we're looking at. So since we're looking at a 1 hour chart, each candle represents price movement in that 1 hour. So we can see the high, the low, the open, or the close. We can also do this on a bar chart, which is sometimes referred to as an OHLC chart. And in this bar chart, we see the same pieces of information: the open, the high, the low, and the close for the period. Simply looking at this chart moves you into the field of technical analysis, because anything done on a chart is in that field. Plain and simple. So then we can move on to more advanced technical analysis. This is a simple triangle chart pattern put on a price movement, and we can then start predicting price as it moves into the apex of the triangle. And we would expect it to come up to our C wave, break off of that resistance, come down to, and come back up and come down and come back. Okay. We've also added some indicators to our chart. Okay. We've added our wave theory to our chart. So we've started adding things on our chart. So we have MACD, we have RSI. Okay. All of this on our charts. So we have price on the charts. We have a price pattern. We have our trend action on the chart. We have an indicator and another indicator. This is a strategy. This is not technical analysis. This is the different pieces of technical analysis you would be incorporating into your trading decision or your trading strategy. So we can go over to even a nicer one right here, or a different one. And in here, we actually see the development of a current pattern called a head and shoulders. Left shoulder, neckline, head, right shoulder, and we're waiting for price to come down, and its price has just fulfilled the neckline, and we're looking for it to move back up to form the right shoulder. If that happens, we can then see a price reversal. Okay, this is helping us to predict which direction the market's going to go, where we might want to enter the asset, and where we might want to sell. But say hypothetically, we were not looking to euro, US dollar. Say we were looking at Amazon. I'd say Trump attacked Amazon again today. Okay, and Jeff Bezos again. So we saw the Amazon price start to fall. Okay. How low do we think it will fall to? At what point will buyers jump in the market anyway because they think it's a good price, a good deal? Okay, how low will it go? You're only going to get this off of a chart. Then we can go to more complex charting methods here, or that's just fairly simple. This is using basics of support and resistance at Fibonacci levels. And down below, we have stochastics and indicator. And you can see how this is combined with candlesticks. And again, it is a trading strategy, a decision-making strategy, and a risk management strategy. And then here we have a beautiful triangle, which is a chart pattern. We have our support and resistance levels. And again, we've combined it with two different indicators. And here we have our indicators diverging from price, and we're waiting for our crossover to our MACD. So we have lots of pieces of information that we're using to predict price movement, okay, and where we might think price might be going. And this is only because what we're doing is we're using these levels and this movement to help us determine our risk reward strategy of if this did that, where would it go? What would my risk be? Where would I exit the market, or where would I put my stop loss? Because first you have to determine whether that trade is worthwhile to make or not. And can you afford to make that trade? And all of this is in that field of technical analysis. Now, we also have in the Forex market and the CFD market something we have to always talk about, which is our bid and our ask. Because in the Forex and CFD market, we have a bid price and an ask price. Okay? Because you don't get the asset at the market price, because somewhere there has to be somebody making some profit or somebody paying the broker. In the old days, it was commission. And if the stock was trading at 129.5, you'd buy it at 129.5, and depending on how much you were buying, you'd write a check to the broker for his commission. Today, we have the bid and the ask. Okay, we have to understand that we have to calculate these in our trading decisions, because we don't want to make a right trade but lose our money because we didn't cover the spread. Now, the charts are the foundations of technical analysis. And in this case, it's really truly a picture worth 1,000 words, because you can see what is happening easily on your charts. Price can also be displayed as a line chart. Now, a line chart is the most simple of all charts, but it's a way to clear out the noise and see simply how price is moving, but not to make a trading decision. Another way to display charts is a bar chart, which we looked at, or a candlestick chart. Here we see the basics of a line chart. Doesn't give us any real information except an overall look at how price is moving. So a simple line chart draws a line from one closing price to the next and then strings them together. Then the bar chart, which we looked at live, and the bar chart and the line chart both give, the bar chart and the candlestick price both give us the open, the close, the high, and the low. And they pull them together with a line at the end of that period. In a bar chart, if we step down from the open to the close, that's considered a bullish candle or bullish time frame. And if we step up from the open to close, that's considered a bearish time frame. Hold on, just let me get my marker off here. Then we have the candlestick charts. And candlesticks and bar charts are very similar, except when we have bullish, we fill in what's called the body of the candle. And if we have bearish, we fill in the body. So, and it's been around, candlesticks have been around since the 1700s, but they've become a lot more popular with the development of computers and online charts and computerized charts, which make them a lot easier to cover. But a candlestick also contains the open, the high, the low, and the close. So they are simply a visual representation of price action. But before you can read a candlestick chart, you need to understand the basic structure of a single candle. Each candle accounts for the specific time period, and it could be a minute, a 60-minute, a daily, a weekly, a monthly. So regardless of time period, a candlestick represents 4 distinct values on a chart: the open, the high, the low, and the close, just like a bar chart. It's a personal decision which one you want to use. I'm a bar chart guy, not a candlestick guy, but that's only because I've been using bar charts for 40 years. Now, technical analysis is the study of historical price action in order to identify patterns and determine probabilities of future movement in the market through the use of technical studies, indicators, and other analysis tools. Technical analysis boils down to 2 things: identifying trends and identifying support and resistance through the use of price charts and other time frames. Because remember, the market can only move 3 ways. That's it. You have no other choices. Markets can either move up, they can move down, or they can zigzag. That's it. And the surprising part, which most people don't realize, is they zigzag or range trade a lot more than they trade up or down. Most markets stay in a range or sideways congestion or something that's not interpretable. So when you can find a strong uptrend or a strong downtrend, you should be spending a lot of time looking at it because it offers excellent trading opportunities. Technical analysis of a market can help you determine not only when and where to enter the market, but much more importantly, when and where to get out of the market. Get out if it's moving against you so you don't lose your shirt, or get out when your profit is at the best point. Now, technical analysis is based on the theory that the markets are chaotic. In other words, no one knows for sure what will happen next. But at the same time, price action is not completely random. In other words, mathematical chaos theory proves that within a state of chaos, there are identifiable patterns that tend to repeat. And these are very important to know. Being able to recognize a channel, a wedge, a head and shoulders, a flag, a pennant, asymmetrical and symmetrical triangles. These are very important because they're telling you something loud and clear. This type of chaotic behavior is observed in nature that form of weather forecasts. For example, most traders will admit that there are no certainties when it comes to predicting exact price movements, just like there's no certainty in predicting the weather. As a result, successful trading is not about being right or wrong. It's all about determining probabilities and taking trades when the odds are in your favor. Part of determining probabilities involves forecasting market direction and when and where to enter into a position, but equally important in determining your risk to reward ratio. Remember, there is no magical combination of technical indicators that will unlock some sort of secret trading strategy. There's lots of gurus out there teaching all types of complicated steps. Fact is, if you use a trend, use support and resistance, and you pick out an indicator that you become an expert at, use volume in there, and always manage your money and your risk-reward ratio, you're going to find that there's no strategy that's out better than the next strategy. Okay. It's your application of that strategy. The secret of successful trading is good risk management, discipline, and the ability to control your emotions. Anyone can guess right and win every once in a while. But without risk management, it is virtually impossible to remain profitable over time. So since chart watching is not infallible, an even more important aspect is that it tells us quickly if our assessment of the market is incorrect. For example, if price moves higher from the triangle pattern in the chart and then falls back within that pattern, we will know that we were incorrect in our original decision to buy. Either we missed something on the chart or the market simply changed its mind. So we sell immediately, book our small loss, and leave our egos at the door. Basic chart analysis is rather easy. Let's lay out a set of basic yet powerful tools so you can perform your own technical tests on a security in which you might be interested. While professional technical analysts have dozens, if not hundreds of tools at their disposal, it all boils down to 3 steps. Seeing where the security is currently trading, figuring out how it got there, determining the power of the trend, and making comparisons of the asset to its peers in the industry if you're comparing stocks, or if you're looking at the euro US dollar, you're looking at the euro pound, you're looking at the euro yen, and then even to its own history. We want to look at trends and trend lines. There's no secret to finding trends. You're going to see the same thing everybody else will see. If prices are generally rising and making higher highs as well as higher lows, then we have a rising trend, and we know that is half the battle. Then support and resistance. These are terms that simply tell us at what price levels are likely to bring out the buyers for demand and sellers for the supply. And we look at this historically. To do this, all we need to do are some key technical tools like moving averages, volume and momentum. Okay. Then we can look at things like relative performance. But once we follow this step-by-step process of making a decision, how do we get this idea to an actual buy or sell decision? So look at the current trend. We want to see if the rising trend or it's just one that's starting to rise. Find nearby support and resistance. We are trying to find a stock or an asset where demand exceeds supply or new supply is not likely to develop soon. Determine if the current trend is healthy. And there are rules for the trend. We want to see it push and ease, push and ease, push and ease, constantly making higher highs and lower and higher lows. So if we can determine that the trend is healthy, we want price to break above the relevant moving average, but not so far above it that the stock is prone to go back or the asset is prone to fall back. Check volume and momentum indicators to make sure they are not fading as the price rises. In other words, are the buyers still entering the market? Are they supporting that price movement? Okay. Are the indicators showing the market's overbought or oversold? So they're warning us that a problem might be occurring out there. So once we've all done that, all we've gotten at that point is a trading candidate. We're just testing the asset. If the asset passes all these tests, we have a candidate to trade. And then we have to start performing our money management, our risk management, and our risk reward ratios. That is not technical analysis. That is part of your risk management, money management skills, which comes in a completely different class. But technical analysis does not have to be all of this complicated stuff out there that these gurus are selling you. All it is trying to find a trading opportunity and a high probability trading opportunity. But no matter how much you're putting into it, will your guesstimate or will your decision be 66% right and mine will be 66.5% right? Doesn't make a difference. If I get out of the market sooner when the market moves against me than you do, guess what? In the long term, you might have had a better strategy, but I made more money. If I stay in the market to the maximum capacity and take the most pips out of that trade, I still make more money than you. So basically, only that strategy is only giving you an entry or a candidate. Okay, well, you don't have to spend as much time developing that trading strategy as you do your risk and reward ratio. So on that note, I'm going to say good night to everybody. Join us for other classes. Now, we do have a class on leverage money management and something else coming up next month. The June schedule is posted, and we'll talk to you again real soon. Thank you for supporting ETX. And I hope you learned a little bit about technical analysis. And I hope I didn't disappoint you, because I know lots of people want to come here and hear me teach MACD and RSI and stochastics. And when it does this, this, and this, buy. And I'm not a proponent of that. I want you to understand your decision-making capabilities and why you're making a decision so that you can make it on your own. So thank you very much, and we'll talk to you again real soon. Good night now.